Well, thank you for joining us for another episode. I am excited today to be able to welcome Jody Bruns. And Jody is not only the founder of the Certified Divorce Lending Professional Organization, but also a mortgage lender. So thank you so much for joining us today.
Hi, Rhonda. I'm glad to be here.
So we will obviously include all of your amazing contact information in the show notes. But as we kick off our time together, one of the questions I always like to ask, and I know this is going to resonate with you, is what is it that you're doing to disrupt the divorce process? And just for those of you who might be joining us for the first time, right? Disrupting isn't mean like, hey, we're going to go in and tick people off. What it means is, hey, let's look at the way that things are being done. How can we do it better? Because we believe that there are ways that things can be done in a more productive, more efficient, and better way. So, what are you doing to disrupt the divorce industry?
Actually, I think the biggest disruption we've made as an association, as a community, is never before did you ever see that a mortgage professional should have a seat at the divorce settlement. They were always an afterthought. And we've really shook things up by saying, no, wait a minute. Our process follows the same process as a divorce. So bring us in now, not after the fact. And I think that it's hard. We get pushback from all kinds of professionals who haven't experienced this yet, thinking we don't need you here. What do you have to say that is going to change what we normally do? So that's what I think.
I love it. I love it. And I love the whole concept of a seat at the table, right? Because I think as women, right, we can really resonate with, we need to be having a seat at the table and having conversations. Pull up a chair, right? I had an opportunity to connect with you at our IDFA conference. And one of the things that I noticed as part of the panel discussion that you were heading up was, this whole concept of team. And I'm sitting in the audience and I'm like, I've been doing this whole concept of integrating a holistic team for literally the last 11 years. I mean, when I first started my business, that's what we were doing. I was always pulling the lenders in early on in the process. And many times people would say, well, Rhonda, why are you doing that? Right? The divorce isn't going to be done for 6, 9, 12 months. And I'm like, because we need to start building that relationship with a trusted advisor on the lending side, but also as I'm helping with unfolding the budget, designing the budget, getting a good handle on income and expenses. One of the biggest questions is, hey, where am I going to live? And a lot of times women in particular go to the worst case scenario, which is, Ron, I'm going to be stuck in an efficiency apartment in a bad neighborhood. And I'm like, time out, right? Or on the flip side, you have the attorneys who are like, well, you can't keep the house. And I'm like, do we know that? Well, no, they just say that I can't. Right?
Yeah.
And so I'm like, we just have to get the information, crunch the numbers. So part of my process, I love it because in working with my clients, I'm helping them understand the current and projected budget. We're getting a baseline of information so that, when it's time to have that conversation with the lender, the mortgage professional, the certified divorce lending professional, early on in the process, we've done the framework. We have the foundation for them to be able to have a really good conversation with you, so that then when they go into negotiations down the road, they are clear on what they need to be asking. They're more clear on what they want. And they're just not accepting the narrative of I can't afford it without actually crunching the numbers to find out.
Well, and I think another aspect of that is what they can afford and what they qualify for may be two entirely different numbers, because I see it all the time. We have, and it's particularly the female, the woman, who thinks, well, I'm getting, an equity buyout, or maybe a maintenance buyout. So I have, say, $200,000 cash coming to me. I am going to get child support. I maybe go back to work, maybe they have other assets that are coming in to equalize it. It's like, okay, you have the cash to make the mortgage payment, but you don't have the income to get the mortgage, and I think that is one of the biggest misconceptions from a financial perspective is I have the money, I can afford the house. Yeah, but you can't get a mortgage.
Yeah. Yeah, no, I mean, I think there's a lot of considerations that go into it. And I think at the end of the day, I mean, I've seen those deals go sideways. And it was prior to working with a CDLP, right? And the lender basically committed, over approved my client, and they didn't understand how to read a marital settlement agreement. They didn't understand how the bonuses came into play as far as the income, and they qualified her for like a $750,000 mortgage. And when I ran the numbers from a cash flow perspective, not from a lending perspective, I was like, I'm not good with anything over 500. You know what I mean? Like, so I was like, and he didn't like me because I was like, wait a minute, can you help me understand like how you came up with the number? Anyways, all that to say, the client and I had a little bit of there was a little static there, right? But I was seeing red flags. Well, here's what happened. Fast forward, she's supposed to be closing on her new home. And the day before she was supposed to do that, the lender called and says, we can't do it. What do you mean you can't do it?
Yeah.
And she had the seller not been willing to wait 2 weeks till we could get that secured with another lender to help her. You know, thankfully I have good people in my corner who was like, yeah, no problem. Send me the stuff. We'll take a look at it. 2 weeks later, they were able to close. She could have lost the house.
Mm-hmm. Yeah. It's our industry as a whole. We have a bad reputation. You know, it used to be when the mortgage industry was just, hitting, it was such a lucrative industry to be in. You'd be at dinner one night and you'd have the waitress talking to you. Maybe she overhears a conversation and you say, oh, well, here's my business card. I'm also a mortgage professional. There's and I hate to use the word professional behind that one. She's a loan originator. It used to be anyone could get their license. They still can, going through the right courses and stuff, but it's like, are you really an expert? Should you even be dealing with this huge asset? But so in our industry, again, you have the people who should not be in the industry, and then you have those like me, for example, I'll say it, who take it seriously. And we want to be able to help everybody. I'll tell you, and this was outside of divorce, one of my most memorable situations I ever worked with, it was a young Hispanic couple, and they were trying to buy their first home. And it was so tight. It was just very tight from a numbers perspective. And when I found out the reason why they adamantly needed this house is because his brother and his wife the sister-in-law were killed in a car accident. And him and his wife were going to get custody of their nieces and nephews. And so it made such an impact for me that I went way above and beyond, got the state involved so that I could get records of, what they would make, what they were going to get paid from the state for taking care of the children. And when you can put the why behind what we do, it makes it so much more impactful. And I think those are the ones that you want in your corner, even in divorce, because, behind every for sale sign is a story, whether it's divorce or maybe I have to refinance the house, not because I want to take cash out, but because I'm going through a divorce. So you have to know the why before you can actually have that desire to help somebody, or else that loan application is just another box to check, in my opinion.
Yeah. No, I mean, and that gives me goosebumps, right? Because I think at the end of the day, these are many of the offline conversations that you and I have had. It's like, hey, listen, within the CDFA space, within the CDLP space, it's okay. Yes, you've got professionals, and then, some of them are doing it kind of part-time, or they're dabbling in it, and it's like, how do we raise that standard of professionals? Because just because you have the letters after your name we're not all created equal.
Absolutely.
And so I just appreciate the work that you're doing. And a lot of times when we're talking, right? I mean, there are certainly some baseline things that we're doing, and then there are some what I would consider like more advanced strategies, right? Like how are we recreating the income, and what does that look like, and how do we make? But again, it goes back to that why, right? Um, so let's talk about a couple things. So the first thing is when we're integrating mortgage planning into divorce planning. Um, there's the planning process. And then it's okay, we get to the end and we've got the marital settlement agreement and we're making sure that all the I's are dotted and T's are crossed. And it's fully, managing the risk for after the divorce is over, right? But also making sure that what has been agreed upon is clearly articulated in that final agreement. And I know that you can help, from beginning to end in regard to that. But let's just talk about, you know, during the planning process. One of the things I know that you will often say is, hey, just because it's a legal option doesn't mean it's a mortgage option, right? So talk to us about that.
So that could obviously go in many different directions. Every divorce, as you know, is very unique. But I'll give you a simple, easy example. Let's say that the husband, this is a real life situation, the husband was keeping the home and he was buying, his wife's share of the equity out. But they also agreed that she was going to use her equity proceeds to pay off debt. And the CDLP in this situation, she had a conversation with the attorney multiple times about not commingling the equity buyout with the debt payoff in the settlement agreement. And he kept telling her, I got it, I got it, I got it. And when she got the final divorce settlement agreement, because she was never given the opportunity to review the draft, guess what? It came back and it was all in one paragraph. Well, you'll have mortgage lenders say, well, yes, then it's a cash out refinance. But what that really means is that we were limited to the equity that was needed in order to facilitate that buyout. So the whole deal crashed. And attorneys, they're not mortgage professionals, and mortgage professionals are not attorneys. But at the same time, they still meet, when the house is in the center of that discussion. And I think it takes a meeting of the minds to strategize, how do we incorporate both the equity buyout and the debt payoff into the settlement agreement, but yet keep it separate so that we can actually get access to the equity in the home that's needed to facilitate that. So that was an easy example.
Well, so talk to us about that. So why did that fall apart?
Because in guideline or in our lending approval and our underwriting guidelines, it specifically says that in order to do a refinance, to do an equity buyout, the only person who can get access to the money is the vacating spouse. But when you incorporate language like they did, that she's to use this money to pay off this debt, it actually converted it into a cash out refinance, which limits us to an 80% loan to value. And he needed to go above and beyond that to access the equity to equalize and pay her out her share. So, I mean, it's a technicality, but every industry has technicalities. It just happens to be ours. So what we needed to happen was address the equity buyout in this section. And then in the settlement agreement where they're discussing or allocating who gets what debt, then say there that the wife is responsible for paying ABC, Visa, or whatever. But if you commingle it, it throws a monkey wrench into what we can actually do on the mortgage side.
So then what ended up happening?
The deal died. I mean, they could not do it. The mortgage would not get approved because he was capped at that 80% loan to value. And so I don't know, I wasn't part of that specific case, but they either had to renegotiate the settlement agreement and come back to the table, or he had to figure out a different way to provide her with the assets so that she could pay the debt off, or they used other assets to pay the debt. I have no idea what the outcome was, but I know it was not favorable. They couldn't do the mortgage loan at that time.
Well, and here's the tricky part about that, right? So, like, I think at the end of the day, when you get the marital settlement agreement, I mean, the property division component, there, when we're looking at it from a global settlement, right? We're looking at all of the pieces. I mean, then you're back to the table, assuming that you can amend it, or
Mhm.
he, in this case, right, is actually the one who gets hosed a little bit because he's going to have to figure out. He's probably going to have to take money from something that he got, or take out another loan, or maybe do a HELOC. I don't know what his options are, but he's going to have to figure out a way to pay for her equity. And
Mhm.
usually, especially with how increasing, prices have increased on homes, it's not usually just a couple bucks. Like this is, he probably was, the most ticked off um, about having to come up with the money because they could say, well, sorry, it's done. Sorry, you couldn't refinance. Too bad, so sad. And you're still going to have to pay for her share of the equity and figure out where it's coming from.
And they still had the debt that she was supposed to pay off. The debt was still there. So, I mean, it's like an avalanche, it just starts snowballing down on you. And it makes so much sense. Just bring in a qualified professional to address the issue at hand. And if it's the mortgage, if it's real property, whether it's the marital home, rental property, second home, bring us in so that we can actually help facilitate putting together an executable agreement. It's not that
Yeah.
difficult.
Yeah. But I mean, it's one of those things too, where like the details matter. I mean, you and I
Mhm.
were talking, and I'm like, I took your 4-hour CE course for CDFAs, and I was like, I have no interest in ever doing this. Like all the, I'm like, I'm doing this because I have to get my 4 hours of CE. And it was painful. I'm like, Jody, just take it and deal with it and help me and tell me what we need to do. So I mean, because again, there is so much detail and it's so technical, and you and I have seen on more than one occasion, right? These deals go sideways. And it's like, okay, there's a better way to do it. And we don't have to be backed up against a wall, to be able to make some of these changes. It's simple. Make sure you've got the right team of people, and weigh in on these situations. So, kind of along those lines, let's talk a little bit about trends. So, I know that over the last couple of years in particular, we've seen where, interest rates went from crazy low rates to, higher rates, which again, it's all relative because there's people listening that may even remember 14, 15% mortgage interest rates. So we're somewhere in the middle of that, but we get kind of spoiled, right? Like, hey, it's low interest and however, the other part of that is, we still can crunch the numbers because you might have a higher interest rate and your mortgage payment per month could be less because you owe less.
That's true.
Right. So, like, talk to us a little bit about that trend and kind of the mindset that you're seeing around that, and what people should be thinking about if they are considering refinancing or purchasing with this quote unquote higher interest rate environment.
Right. So everybody over the last, 2 or 3 years ago during COVID, rates were historically low. I have seen people with 30-year fixed mortgage rates in the upper twos. More common is 3.25%. Well, obviously, nobody wants to refinance a 3.25% interest rate to 6.5 or 7. Nobody would. And I get it. But what I find is that when somebody who is going to retain the marital home, they have to get their other spouse off of the mortgage, and they're told you have to refinance, and they're looking at an interest rate that's close to double. It's like, I don't want to do it. So you're right from two different aspects. One, they need to look at what the actual interest rate is now with their projected payoff, because if you took out an original mortgage of 500,000, it's paid down a little bit, so you're not going back up there, and it may not be that big of a difference depending on the balance. The other thing is, and we see this a lot when we crunch our numbers, is what is your actual tax going to be at the end of the year? Because most people don't take into consideration that their filing status is going to change. They're going from married filing jointly to single or head of household. And it really does impact your adjusted gross income. So if you are going from married filing jointly, for example, to single, your standard deduction is cut almost in half. And so you may end up paying Uncle Sam at the end of the year if you wanted to keep that lower interest rate. But what I find is when people are saying, no, I want this rate, I'm not giving up this interest rate, they're not fixated on the rate. They're focused on the cash flow because some of their income is walking out the door. So we have to recognize what the true concern is. Is it the rate or is it the cash flow? And then what can we do from a mortgage perspective to help mitigate that higher payment that might be coming in? But you're right. You can't assume that it's going to be ugly. I did an analysis once where the original balance of the mortgage was like $550,000, and it was a 3.25% interest rate, and the payoff was closer to 400. So when we did 400 at I think we did it at 5 1/8 because we were just trying to figure out where that sweet spot was. There was like $50 difference in payment just because the principal balance had shifted so much.
Right. That's right.
And if you go up to 6.5% and you take into consideration the tax implications, it's not even that ugly. So I think people just need to open their eyes and look at it through a new lens and not have this tunnel vision where 3.25%, 3.25%, not giving it. So.
Yeah, I mean, I think we've been trained a little bit to just focus on the interest rate, but I mean, for the people that are going through divorce, the picture is just so much bigger than that. And again, I love that because there's been so many times where I've seen it's like, oh, it's actually not that big of a deal. So making sure that we've got the information to help people make good decisions in that regard, I think is important. And that way then too, like for the women that are listening, like if your spouse like, oh, you can't afford it, well, okay, let's get the numbers. Let's find out if that's really true. And what would that look like? So those are all important conversations, I think, to be having. And I love it that you can crunch the numbers because each situation is going to be different. We need to dial in the data. We need to make sure that we're crunching the numbers so that then when we get to the negotiating table, right, we can make good decisions on what that's going to look like. And you and I've had a conversation with a woman recently, and I was like, I don't think this is a good idea at all. Your expectation on buying, a 7-figure house at this point is outside of what I can see is going to be good for you. What if you said, I'm going to look at a $700,000 house? How would you start there and look in your area because your cash flow, and the income that you could be producing from the investments that you're going to get would be sufficient for that. So I think some of it is just, re-looking at what assets we have available, what income we have available, and being willing to maybe think outside the box a little bit. And dialing in that data.
I think they get tied into this perception that they have to have the house that is equal to or better than they're leaving. And I think that when they have to downsize, they see it as a negative. They see it as they're settling for something less than what they're accustomed to. And they don't see the opportunity that could actually present to them from living a better life.
Yeah, I mean, absolutely. And there might be people that are listening like, well, I don't really feel bad for somebody who can buy a $700,000 house. But let me just say, like it's all pro rata, right? I mean, at the end of the day, no matter where you're at, you might be looking at something that's a little bit less. But again, I don't want anybody to be, house rich and cash poor and feeling so stressed that they have to be able to work so many hours because they feel like they have to either maintain the marital home or, purchase something that's outside of the scope of what they should be doing. And you're right. Some of this is temporary. Like, listen, if you can be somewhere where you don't have to take care of the grass, you don't have to take care of the pool, you don't have to take care of anything, and you can just get your feet under you and then revisit it, that's okay. Like, I think there's just an aspect of that people need to look at the simplicity for them to just get their feet under them again before they move forward.
I think too that many women who are mothers they are tied to the family home. They think it's the divorce is a disruptor enough, and they don't want to disrupt their children's lives even more. And I think that they need to see beyond that, trust in the resilience of the kids, and that they want their parents to be happy. They don't want them struggling, and just to let that go and be there for the child, no matter what house you live in. But
Yeah.
I see that's more common with women that I work with than men.
Yeah. Yeah, I mean, I definitely think it's an interesting component, and I think at the end of the day, the kids oftentimes, while they might articulate that, oh, I'm really wanting to stay in this house, right? I think you're right. I mean, they want to be where their parents are, where their parent is. And I think also as parents, I mean, we have an opportunity to show them there's going to always be change in life. It's just the reality of it, right? And so we have an opportunity to model what does that change look like? How can we be positive? How can we embrace new opportunities? I mean, this brings me back to remembering my kids had changed schools in elementary and they still kind of give me a hard time about it. And they're all in high school and beyond. Like, Mom, we can't believe it. I'm like, listen, the one thing that, Tim and I did really well during that time was we created an opportunity for them to weather that. And it doesn't mean they liked it, right? But we didn't have a choice. The school was closing and we had to go a different direction. And, but we modeled healthy communication, we modeled new opportunities. We assured them that we were going to make decisions that were in their best interest. We weren't just going to go rogue and put them wherever, like we were going to be thinking about their specific needs. And I saw there were a lot of people that did not do that well, and they just didn't have the knowledge or the skills to say we can lead by example on how we're handling transitions and use it as a learning opportunity to say life's going to give us changes, whether it's
Yeah.
health changes, job changes, school changes. I mean, there's always going to be change.
I think there's too many knee-jerk reactions in divorce and finance and around the house and around the kids. And you're right. And that bodes well for why you need this expanded support team, not just an attorney, not just a mediator, but somebody who can actually help you see all the different faces of change that you have to deal with, and let that corresponding expert work with you to find the actual solutions that work best in your favor.
Yeah. Yeah, no, absolutely. I totally agree with that. So, one of the other areas that I know that you and I have talked about is loan assumptions. And it kind of ties into what we were talking about with interest rates. But let's talk a little bit about the loan assumptions and kind of, the details, the trends around that.
Well, there are two types of loan assumptions available. One is called a simple transfer or a legal transfer assumption. That is where the lender's not involved. There's no change in who's legally responsibility or responsible for the mortgage. It literally comes down to one party, air quotes here, assuming legal responsibility for making the existing mortgage payment. Okay. They're protected under the Garn-St. Germain Act, and the lender cannot accelerate the due on sale clause if ownership is transferred. The thing I want to clarify on that is when I say you assume legal responsibility, it's called a legal transfer assumption. Oh, I can assume the loan and the lender has nothing to say about it. No, you're not assuming who's responsible should you default. Then you have the qualified assumption is the one that everyone wants, because you go through the qualification process, and then if is a big if you are approved by the lender, then the other borrower is released from their liability. Here's my issues with that. Number one, you still have to be qualified. So you still need divorce mortgage planning, because we need to make sure that all the numbers, the debt, the income is still there as though you were qualifying for a refinance, right? The other thing is that the divorce has to be final before they will look at it.
Yep.
So the divorce has to be final. And
yes, no, I was just going to say along those lines. So I'm just thinking, like, so there have been times when we have done a partial agreement on only the financial aspect so that we can get the lending piece done. So, and in that case, the divorce wasn't final. So I think that's an important thing though, because you have to have the attorneys who are willing to, do that.
Yeah, so the divorce has to be final. And if there's any equity that, like an equity buyout that has to be done, it has
Yeah.
to be done before you can do the assumption, because the lender is not going to want a potential lien out there or a judgment against the house that's not been taken care of yet. So it's very hard to coordinate a full qualified assumption in a divorce.
Yeah.
And here's the other thing. They will usually take up to 6 months to give you an answer. And sometimes they're not coming back with the same terms. You know, I've seen the big servicers, they want a, $15,000 principal reduction.
Yep.
Well, that's not going along with the existing terms of the loan. So I say, if you're going to look at doing a loan assumption, also look into what your other options are should they come back and say no, because that's a real possibility.
No, absolutely. Absolutely. And I think at the end of the day, those are all the things, right, that people need to be thinking about or considering when they're looking at a loan assumption. Because, okay, if it goes sideways, then what? We've got a property division agreement that's already signed. Where do we go from there?
Yep. Yeah. It takes a lot of coordination coming. And the other thing is there's no standard across the industry. The ability to do a loan assumption, the requirements to do a loan assumption are independent of each lender. And the lender can say, no, your loan is not assumable, or yes, we'll allow it. There's nothing across the board that we can follow as an industry.
Yeah, I mean, absolutely. And I remember, when they first started doing loan assumptions, there was only a couple lenders who would do them. Wells Fargo was one of them, right? And then, more and more people. And the only way you would know, right, is you got to call them, you got to talk to the right person, right? Not just the person who answers the phone.
Exactly.
It's like no, we don't do that. And they, you're like, wait a minute, wait, yes, they do. I've worked with other clients who've worked with that institution, and I know that they do it. So call back and talk to somebody.
It depends too on what type of loan it is, because it used to only be that the government loans, FHA and VA, were assumable. But over the last year or so, more and more conventional conforming loans, the lenders will come back and say, okay, yes, we'll let you go or apply for an assumption because we now see divorce as a life event. But again, that's not across the board.
Yeah.
And if you have a jumbo loan, it might not be an option there either. So
define jumbo loan.
So that loan amount changes every single year. And it's dependent upon where you live. But right now, if I don't actively originate all the time, so that the new loan conforming loan amount is in the 800,000s. It used to be 300. So you can see that as real estate continues to appreciate, so does the conforming loan limit. So it's dependent. But if you exceed that, you go into the jumbo loan where you have like the 900, the $1 million mortgages. They have their own set of rules out there. So nothing is a given in our industry.
Yeah. Yeah. I mean, I think it's a matter of asking the right person, the right questions, and then, making sure that, okay, and perhaps, I don't know if you end up doing this when you're looking or reviewing at marital settlement agreements, but I know we'll do this sometimes on the financial side, which is if this, then this, right? So like if we're going to do a loan assumption, we've been told we can do it, but if we can't, then this. Have you seen that?
I think again, it depends, number one, who's involved. I have seen it where the attorneys, they don't have the out in the clause. It just specifically says, the wife is to assume the mortgage. If not, refinance within a certain amount of time, though. They only give them, 90 days. Well, it's going to take 6 months, to
Well,
even get an
right,
answer. And then if
right.
they come back and they say no, then you have to start the refinance process and hope that you still have enough support income to
Yeah.
qualify if you're using it, because that changes. That's a time frame we have to work within. And I just think setting the expectations up early on is super important.
Yeah. It's huge because I think the other piece of it is the default is if we can't do it, then the house gets sold.
Like, for example, I was just working with these two spouses out in Colorado. And the one spouse, she wanted to keep the marital home. She was newly self-employed, so she didn't have the 2-year employment history that's needed for the mortgage. And the other spouse, she wanted to move on, get her own house, but she was still tied to the existing mortgage, even though she said, I fully have faith in her. She will not miss a payment. She's very financial savvy. She's got the income. Well, when I saw the attorney's draft come back, they never had any of those what ifs. They never had any expectations set. So I worked with them on incorporating language into the settlement agreement that gave the one spouse the 24 months that she was going to need for the self-employment income. But then we built into the clause that if the assumption was denied, because she has to wait 2 years before she can apply for an assumption because she won't qualify.
Yep. Yep.
Then we built in that additional 6-month time frame, and then if it's denied, she then still has the opportunity to refinance or sell the property. So you have to set the expectations up. And I'll even caveat that one with the spouse that was leaving. She said to me when I was trying to explain to her the whole process, she goes, I just want to move on. I don't want to be tied to the mortgage. I just want to move on. And so, as a trained professional in the divorce arena, I was able to say to her, I stepped back, stopped the conversation about mortgages. And I said to her, I go, but you are moving on. You can move forward. If we use the correct language in the settlement agreement, the lender will not count this existing mortgage against you, so you can move forward. Where if you don't have somebody trained in those kind of mediation skills, negotiation skills, they're just going to plow over that comment, and you may not have capped that conflict, and you may have just blown it out of the water. Well, nope, I can't get a mortgage. I want to move on. So just sell the house now. And I think that's where all the professionals involved should understand the dynamics of divorce and how to diffuse that potential conflict in there.
Yeah. Yeah. I mean, I think that's key, right? And I love it when we can be reviewing, the financial aspects before the divorce is final. I kind of joke, but it's true. Like if I don't have a chance to weigh in on an MSA, I don't want to see it. Because I'm sure you're the same. You're like, oh my gosh, we would see all the things that we could have done differently that would alleviate frustration or headache or issues. And I was like, oh, don't even show it to me. If you haven't signed it, we can talk. If not, I don't want to look at it.
Oh, and think of it this, there's not a lot of mortgage professionals who come in, get their license thinking that they're going to be providing input or suggested language in a settlement agreement. They think, well, that's where the attorneys come in play. And that's where I am really proud of our CDLPs, our certified divorce lending professionals, is we teach them that confidence and teach them that you do have a seat at that settlement table.
That's right.
Because the input that you can provide can actually determine if both spouses can qualify for mortgage financing post-divorce. It shouldn't be overlooked. It should be totally integrated in the divorce case all the time.
Yeah. Yeah. No, absolutely. Absolutely. Well, I know we have covered a lot of ground in a short period of time. And so I want to thank you so much for your time today. As we wrap up, any final thoughts or comments that you want to leave our listeners with today?
Number one, from just a personal standpoint, I would tell them to stay strong and get empowered don't feel defeated. I know personally that divorce can be very devastating, but there's always hope after it's done. And if you are wondering what your housing options are, reach out to a CDLP. We have them nationally. We're in every single state, and make sure that you are insisting that your divorce team incorporates divorce mortgage planning into your own personal divorce settlement.
Absolutely. Well, Jody, thank you on multiple levels for all the work that you're doing to advocate for people. You're making changes within the industry, you're making changes within the process, and client by client, right? We are making a difference.
We are at that.
So thank you so much for sharing your time and your expertise today with my listeners.
All right. Well, thank you very much, Rhonda.